The investment allocation that could have been completely right and good during accumulation can just as easily be wrong during the distribution phase of life. Hey everyone, I am Andrew. I'm the owner of Lever Wealth Management, which is a financial advisor for people who scare financial advisors. I'm also a CFA charter holder and a CFP professional who spent the last several years helping ultra high net worth and high net worth investors take their complex financial lives, and I take the thousands of iterations of those conversations and the learnings from them, and I give them to you so that you can apply them to your own life. And today I want to tell a story. The name I'm using today is Jim. So Jim had come in and was a new client from a different firm. The investment selection was done really well for an accumulator. The problem was he was trying to retire. And once I start looking at the investments, I notice the Roth IRA, the tax-free account, has all of his stocks, or it has only stocks rather. The IRA has a bunch of mortgage-backed securities. I'm sure you've heard of them. Fannie Mae, Freddie Mac, Ginnie Mae. And a lot of times people will put those in accounts. You get a little bit of a yield boost. You buy the individual securities over and above the aggregate bond index, and you still get the stamp of approval from the government. The problem is the drawdown structure of those bonds. Keep this for bingo night for what it's worth. As prepayments occur of mortgages, the principal and interest goes down at a convex rate. If interest rates are going down and people are refinancing a lot, well, then these bonds will get paid down. And sometimes you end up with these odd denominations. You bought $10,000 of this bond that comes due in 2033, and now it's $2,720. The problem is you can't sell it at that point. Nobody buys it. If you get a bid, it may be 80 cents on the dollar. What's the point I'm getting at here? He had all of these odd lot bonds in his IRA that had performed well. And then in his taxable account, he had some individual municipal bonds because he was in a high income tax bracket. And he had some ETFs for stock exposure. When we go through the planning, it shows it makes a lot of sense for him to do some Roth conversions. He's needing an income now, and he wants to keep the Roth IRA for inheritance for his kids. Well, the problem is his liquidity structure in the accounts is all jacked up. First of all, almost all of his fixed income is in the IRA. Great during the accumulation phase to do asset location. It increases the tax efficiency of your investment structure. The problem is the bonds that he has in there are so illiquid, it's very difficult to get rid of them. And so if we want to do Roth conversions, we either have to move the positions in kind, and now we're diluting the equity exposure in his Roth IRA. That's a bummer. Or we're selling and we're getting 80, maybe 90 cents on the dollar. That's a bummer. On the individual side, what you end up with is if we do the Roth conversions, he has a tax liability, right? And so we need to pay that tax from somewhere. If we sell the stocks, we're going to pay a capital gain. The individual municipal bonds that he has on the taxable side did not line up at all with his liquidity needs. And you end up with a similar issue on the muni bond side. It's a really, really illiquid market. Most people don't know that. You'll take a haircut of 2 to 5 percentage points if you're a retail trader. And so he's needing $100,000 of income this next year. All of his municipal bonds are targeting a duration of 6.5, 7. So they're not laddered out. It's tough to sell them. If we want to pay tax on the Roth conversions, we have to sell stock and realize the capital gain. If we do that, we're increasing his AGI. Now we're starting to hit some of the Medicare surcharge. And it became an issue. And we were able to work through it over time. But it ended up taking a transition plan of probably about 3 years. And some of those bonds end up having to stay in the account regardless. What's the so what in all of this? The so what is that allocation actually wasn't bad. It was just bad for Jim at that stage of life. When he was accumulating money, you can take illiquidity risk and you can get the increased yield from those bonds, from the mortgage-backed securities and the individual municipals. You don't have to worry about lining up cash flows and the asset liability management. You're worried about things like credit risk, targeting the right duration, those types of things. Having all of his stocks in his Roth IRA made sense then, and on the back end still made some sense. But what was right then became very wrong right when he was needing to turn the switch and become retired. These decisions do not occur in a vacuum. And what was right for one period of life may be wrong for another period of life. My encouragement to you today is those 3 to 5 years before retirement is time to do the housekeeping, because you may have made some decisions during the accumulation phase of your life that are going to create unnecessary complexity during the decumulation phase of your life. And in addition to that, the 3 to 5 years after retirement are so important to systematically reduce things like sequence of returns risk, right? Good planning is done in advance so that when the proverbial crap hits the fan, maybe it didn't occur in the way you expected it to, but you knew eventually something wasn't going to go the way you wanted, and you had planned for it. That occurs from making good decisions ahead of time. Go at this and understand and look at your own portfolio and say, is what I'm doing today going to create unnecessary complexity and issues tomorrow? If that tomorrow is in 10 or 15 years, you have plenty of time to unwind some transactions. But if tomorrow is literally tomorrow, it can become a problem very quick. So again, my encouragement to you, review your own portfolio. Understand these things do not occur in a vacuum. And just like Jim, what was once a very good decision could end up being the completely wrong decision given your specific set of circumstances. So until next time, thanks everyone for watching. Talk to you soon. Bye.